Good morning and welcome to Missoula Real Estate Today. This is Peter Christian. I'm here with the host of the show, Diane Beck, with Windermere Real Estate. Diane has been helping buyers and sellers with real estate in the Missoula area for over 20 years and is very active in the Missoula community. Along with their trusted partners, Diane provides complete service for your real estate transaction. And now, Missoula Real Estate Today on NewsTalkKGVO.com. 98.3 FM and 1290 AM. Welcome once again, everybody. We are transitioning now into November. Can you believe the year is almost over? I mean, 2018 is almost in the books. That just blows my mind. Joining me this morning, Diane Beck, of course, not here today, but we do have Myles Link from Opportunity Bank joining us. How you doing? It's been a little while since we've seen you.
It has been. I'm doing pretty well. How about yourself?
Doing great. Great. Still, my hair is still gray. Mm-hmm. At least I still have some.
I was going to say, at least you have some, yeah.
So I'm happy about that. Yeah. All right, so now we are coming in the real estate world. This is the time that traditionally we start going into a little bit of a down segment because spring and summer are really hot and heavy. Everybody wants to sell. Now we're into deep fall and heading into winter time. So what are things like at Opportunity Bank right now?
It's like Diane always says, everything's markets are local.
Right.
Missoula seems to be, typical. We're slowing down a little bit going into fall, and it's like you said, it's moving fast. I mean, Thanksgiving's just over 2 weeks away. But
now let me just bring something up here. There's nothing to do with real estate or whatever. Does it feel to you, and I'm just talking on a sociological level, does it feel to you that time literally is going faster and faster?
Yes, it especially this time of year.
Yeah.
But it seems to really slow up after January.
Oh, does it really?
Well,
Okay.
it seems to me like, winter's upon us and you start thinking snow's coming and that sort of thing. And then when you're ready to get rid of it in January and February, it seems like it just stays and stays and stays and time slows up.
Yes, you almost to hold your breath till April 1st or something like that. But anyway, so we're not here to talk about that. We're here to talk about Opportunity Bank. So as you'd mentioned, the markets are local. So I'm assuming you guys are still busy.
We are busy. It's definitely with what I was going to say is with the time of year, we kind of do see a slowdown a little bit. There are some markets in the state, though, that are still moving as fast as they were this summer.
Sure.
Bozeman market, Kalispell's pretty hot. Missoula is kind of following the trend as far as it's the time of year, and Thanksgiving, once Thanksgiving hits and into Christmas, we kind of see that slow down a little bit, that seasonal slowdown, and then it picks back up after the first of the year.
Right. Now, you and I were talking economics a little bit before the show. And that's when President Trump came in and the tax cut thing passed and the deficits began to go up. And then the Federal Reserve said, we better do our job here and make sure we don't get too crazy, and started raising interest rates incrementally. And we've had several so far, right? About 5 or 6? Something like that?
Correct, yeah.
So how does that affect the people that are out there trying to purchase homes or sell homes right now?
In the rate that the Fed sets doesn't have a direct correlation to mortgage rates, which we've talked about in the past. The mortgage rates are tied to the bond markets, but it's the signal that it's sending. When they're raising interest rates, the Federal Reserve is sending the signal that the economy is booming. We're going to have to start fighting inflation and things of that nature. And what that in turn does is, the big movers and shakers, the pension companies, the bond, big players in the market, they don't want their money sitting on the sidelines in bonds. They want it in the market in play. And so when we see the market doing well and businesses doing well, bond markets tend to have that sell-off, and that's where we see our rates go up. And we've seen that with and here a few weeks ago, we've kind of started to see, I don't know if it'll continue, but some kind of a quasi correction in the stock market off and on. And those days where the market gets hit, we see a direct correlation to our interest rates. We sometimes drop 1/8% because when the market starts really going, they flee to bonds, and it helps us.
So it all confirms my statement that I've made many times: is there's no such thing as good economic news. right?
Right.
Because if it's good for stocks, it's bad for bonds. If it's good for bonds, it's bad for stocks. If it's good for this, it's bad for that. So it's kind of like that old comic routine, you know? So where are we right now?
Yeah, and there's always, like you say, what's good for someone is always going to be there's someone that's affected negatively.
So that kind of creates a bit of a balance, though, right? That's what we're looking for.
And that's why, in a time like now where the economy seems to be moving in a positive direction, interest rates are going up as well. But people have money. People have money to spend, and people feel comfortable in their jobs. And so a little hike in an interest rate isn't the end of the world. Whereas when we're in a recessionary period, our interest rates are great, but sometimes people don't feel as comfortable as far as wanting to go out and buy a new home.
Just looking at the basic economy, I mean, jobs going nuts right now. There are employers that literally can't find enough people to fill jobs, which is something that has been very unusual, especially when we went through the Great Recession, capital G, capital R, starting in 2008. It was a dreadful time. And then, boom, we are in an area of growth right now that some people get scared about. I mean, are we growing too fast? So that's where the Federal Reserve comes in and says we need to equalize things a little bit. So where are mortgage rates right now? Forget interest rates from the government, but where are mortgage rates? Just ballpark figure.
Yeah, ballpark figure. I mean, a 30-year fixed mortgage is still in the high 4s.
Really?
So we haven't, it's still below 5%. We've really we've been right up to that 5% mark, though. And, of course, that depends on credit and down payment. But in general, we're just below 5%, which you and I have had discussions over the years about, in the 80s and what interest rates were. And you couldn't sell a house if you wanted to. And so, where interest rates are right now, they're pretty darn good.
Well, just for those of us that didn't have the opportunity to go back in time with us, I will tell you, when I first moved to Missoula, I bought my first house in the late 70s, and I paid, I think it was $24,000 for a house over on 10th Street. And I was turning backflips because I got a Board of Housing loan for like 12.5%. And I was thrilled because I at that time, interest rates were up 15, 16, 17% for a mortgage. And so it's kind of, again, it balances out because you have a lower priced house with a higher priced mortgage. And so you're able to afford it. I'm not sure how they work all that, but they managed to do it.
Yeah, it seems to fall into place. But, so rates are still really good, historically speaking. The market's still healthy. It seems like I'm looking at the market right now and seeing a little bit of a, I wouldn't say a downward trend, but the prices aren't spiking like they were. They're kind of
they're leveling
out a little bit, and that's expected. We have those cycles, and I think part of that is interest rates a little bit, but part of it's the time of year, and there aren't as many people wanting to move during Thanksgiving or Christmas or the holidays.
Now you're a mortgage lender, and I know that one of the things that they wanted to do after the Great Recession was that they realized that credit was just too easy for people. That was one of the contributing factors to the recession. They had this big housing crash, and of course the markets didn't help much with the way they combined all the mortgages, and they fell flat. And so the government came in and said, okay, we're going to kind of tighten things up a little bit for folks who want to purchase a home. Is that still in existence, or have they relaxed that a little bit?
They did tighten things up, and for the most part, it's still in existence, but they've loosened up some areas. I always said, no matter if somebody deserved a loan back then, they deserve a loan now. It didn't get it really didn't get any harder, other than a little bit more documentation laden. And they went across the T's and dot the I's and make sure. But so there is a little bit more documentation at times, but it's nothing to be fearful of. If you deserve a loan, you're going to get a loan.
Sure.
And I think what it's in turn going to do is when we do see that downward turn possibly in values and, that cyclical change, which the economy always goes in the cycles, I think we'll be a little bit more insulated from that deep crash that we saw last time.
Now we have a whole half an hour. We've only used up 10 minutes so far. But if you wouldn't mind, one of the things we like to do when we have folks like you who are really good at what you do, and you've been doing it for a long time. Give us the mechanisms on how interest rates are established for mortgage rates. How do you come upon it's a 4.6 or a 3.9, or how do you get to that?
Yeah, I mean, in general, rates in general are for mortgages are tied to the bond markets, which we just discussed.
Right.
And so it's a supply and demand on the bond markets, and that's how the rates are established in general. Then when we get into meeting with a customer, discussing down payment, credit, things of that nature, each loan product has a slightly different rate as well, whether you're using a government loan or whether you're using a VA or an FHA or you're doing a conventional loan, and depending on your down payment. So there's a baseline of interest rates for each product, and then you go a little bit deeper into what's your credit score,
then it's personalized, right?
Then it's personalized,
right.
Based on your individual situation of and where your credit, your profile is from credit to down payment and those things. And then, obviously, like we've discussed before, credit's just very important. That's a big mechanism of how the banks determine, this is the biggest purchase of your life. And by looking at your historical data on how you've paid your payments gives us an idea of how you're going to pay the payment on the largest purchase you'll ever make.
Yeah, and they're not trying to pick on you, because you have to remember that this is an establishment that doesn't know you from Adam, right? Especially when you're talking Fannie Mae and Freddie Mac, or even the larger banks, or even the local banks. You walk in there, they don't know you, you don't know them, and so you're asking them to believe in you enough to lend you up to maybe $350,000 for a home. And so there's a lot riding on your narrow little shoulders here to let them know that you're worth that money, right?
That's exactly right. And unfortunately, or fortunately, depending on the situation, credit's a big one that we lean on, because that shows that history. What's your history of being able to pay off a $5,000 loan? And that gives us something to go on of what can we expect if we give you $300,000, like you say.
Right.
But as far as some of the loan programs out there, some of the government loans, the first-time home buyer loans, a lot of those do have a little bit more lenient credit score criteria. And so that's why when we meet individually, we try to determine what product is going to meet that individual's needs based on their situation.
Right. Now, credit score, I always like to go over this because we get new listeners every time you're on. People hear the term credit score and they realize, well, there's 3 mysterious agencies and they gather up all this information and they're the ones that can decide. I mean, it's kind of spooky in some sense because just finished Halloween. So tell me about the 3 wise men, or the 3 wise agencies, if you will, that come up with where all these interest rates come from.
Yeah,
or the credit ratings, rather.
Yeah, it's and everybody's probably heard of them because I think Equifax got hacked last year.
Right, exactly.
And what have you. So there's Equifax, TransUnion, and Experian. Those are the 3 credit bureaus that the institutions report to.
Why are there 3 and not 5 or 1 or 10 or these are the 3 that have just emerged as the leaders in the industry?
I don't know the answer to that, but I know when you go get a car loan, for instance, they may pull because the banks or the institutions are charged to access or report to the bureaus. And so some car loan, if you go get a car loan, they may only pull one credit bureau. So you may go get a car and then you come into me and you say, gosh, I just got a car, my score's 750. Mm-hmm. And then we pull your credit, which for a mortgage, we pull a score from each bureau and we use the middle, and it may be the middle score is Equifax and that's lower.
Right.
Well, the reason that we do pull a tri-merge is institutions also sometimes only report to one. So we have to pull, in all bank, it's universal nationwide. They pull a credit score from each bureau because your credit card out there, your car loan or your snowmobile loan, they may only report to one credit bureau. And if we don't pull that bureau, we don't get a full picture of your credit profile. So I don't know why there are 3, but when you go apply for a mortgage, we do pull all 3, and then we use the middle score of the 3 to determine what loan program, interest rate, et cetera, that we're going to kind of work toward.
So if there's a young person out there, maybe just getting out of high school, getting out of college, and really just getting started in the, if you want to call it the real world, where you have to have credit in order able to do things. How does one build credit? I mean, is it just, it's not just bestowed upon you by your parents, like blonde hair or height or whatever. I mean, you have to be able to earn a credit rating.
Yeah. And what we see with a lot of young adults coming out of college is the first thing that they have on credit are student loans.
Right. Ooh, yeah. Right. Yeah.
But the thing about student loans is that once you get into that repayment period, it is an installment debt. If you've taken out maybe 3 student loans over the 3, different maybe years that you were in school or what have you, you may consolidate those and pay one payment, but they still report to the bureaus as separate loans.
Wow.
Like as when you took them out.
Right.
And so the nice thing about that is if you continue to make those payments, it shows up as 3 different or 4 different or how many different loans you took out, different installment loans, which are a big credit boost if you're making those payments. And then it's always wise to, I always say at a young age, try to get a credit card. Maybe it's a $500 limit or even a secured card. If they won't give you one because you don't have any credit, you can give them $300 and then they'll secure it with that $300 and continue to use it and pay it off and use it and pay it off, because it is hard in your young 20s when you come in and you have no credit history, because the bank wants to see some credit history.
Yeah, and again, they're taking a risk on you, and if there's no dependable way of finding out if you're good for this loan, you're not going to get it, right?
Yeah, it makes it difficult. We do have certain loans have options of trying to formulate a credit history with power bills and phone bills, but it still isn't a true picture of paying off a loan.
Right. My personal credit is, last time I checked anyway, was 825. So, which is pretty good, right?
Yes, very good.
So the reason it's that way is because I have a wife who beats me about the head and shoulders to make sure that we make our bills on time, and we paid off our credit cards, and we've just finally paid off our house. So but I'm in my 60s now, so that's 30, 40 years of working towards that area, and so I'm feeling really good about that. About some of the decisions I made. Others don't feel so good about, but I really feel good about that. And so that's something that people can build toward, right?
Correct. Yeah. And, and credit isn't, a lot of people view credit as such a negative thing to have credit out there. Well, installment loans are great. Credit cards show the ability to put something on credit and pay it off, Right. And so one of the big percentage criterias of credit scoring is credit balances on credit cards. And so it'll look at the balance if your credit limit is $5,000 and, how close are you to that limit? The magic number there is typically you hear is 30%. So you want to keep that credit card limit at 30% of the balance. But oftentimes I'll see somebody go out there and instead of having, 2 credit cards at $500 limit and they maybe owe a couple hundred on each, they'll consolidate and they'll put them all on one credit card. And now they have one credit card with a balance, but the balance is almost maxed out. Well, that impacts your score more negatively than maybe having it spread over 2 cards with lower balance.
Now, one of the things I talk with Greg Harper when he's on with us, he used to be on with us anyway, was the fact that people come to him all the time with several credit cards that are totally maxed out. I mean, and so when someone comes to you like that, and you're sitting across the table from them, and they show you all this, what kind of message do you give them?
I mean, depending if we can get them a loan or not, but the biggest thing is you really need to try to get those balances on those credit cards down. Mm-hmm. I mean, that is and it's a large impact. It's over 30% of your credit score is the balance is the balance of your revolving debt and the usage of that revolving debt to the credit limit. And so I really counsel them on, you need to try to get those balances down. And also, if you don't have a home or a mortgage payment and your balances are that high, what's it going to be like when you do have a mortgage payment?
Right.
And with home ownership, it's a wonderful thing. But as you know, unforeseen expenses pop up too, the furnace, and of course,
the water heater, the roof, whatever. Yeah.
2 people in my office this year, when they went to turn their heat on the end of September, their furnace didn't turn on, because you just, those are the unforeseen things, and you just need to have the reserves or, the ability to pay for some of those things when they come up, and that's why if you have everything maxed out, you might be just kind of living on that thread.
Right. So let me ask: would you be willing, if a high school class or a math teacher or whatever, home economics teacher called you and said, "Myles, could you come and speak to my class because their high school kids are going to be hitting the college and then they'll be going out into the world"? What kind of advice would you give these 16, 17, 18-year-old kids who are looking at you as a professional in the mortgage industry, so that they can be successful when they get into the area where they want to get a mortgage?
I would definitely do that. And I know a few years back, I know Diane was working with a group at Hellgate, finance type class, and I'm not sure what's went on with that. But,
right.
But I didn't speak to them. But the biggest thing I think with high school kids and going into college is some of those kids, or a majority of those kids, aren't going to be able to, mom and dad aren't going to be able to pay for college. So they may have to take out student loans.
Right.
The biggest thing I think I would counsel them on, just on the student loan piece, just that piece alone, is take out the amount of loans that you need, and don't use the student loan as an open checkbook, because what you end up finding is maybe school is $5,000 a semester,
right?
And they want $10,000 a semester, so they have the $5,000 to go play and go do their things. And if you can keep those, take what you need to get through school and get things paid for. But you may have to work a bit. You need to work, and you need to bring in some of your own income, because it's amazing when you have people come out of college and they have $50,000 in student loans, and they have a job that they're making $25,000.
Right.
And then they have their student loans in deferment. And then they come to me for a loan when they're 30 and their student loans are still in deferment. And, those things never go away.
No, they don't.
The days of bankruptcy and all those kinds of things eliminating student loans are gone. So those things are going to be with you until you pay them off. And I think that would be the student loans, and then taking out credit cards and abusing those credit cards would be the 2 biggest things I would counsel high school kids on.
Or any kids.
Any kids. But, use that credit wisely, because it's going to help you establish credit when you go to buy a home or what have you. But don't get it to a situation where, one, you take out more student loans than you can ever fathom paying back. And on your credit cards, make sure you can keep them at a limit that you can pay them off.
So for those that come in and are really crestfallen when they see that, gosh, your credit score is really bad, and so what kind of advice can you give those folks to say, here's how we can help repair this credit? If there's been some mistakes, or you made some mistakes in the past, how do we go about repairing that?
Yeah, whether it's paying down some of the balances to get the score up, or if there are some past issues, lingering collections, things like that. We, like you said, there's the 3 mysterious credit bureaus. Nobody truly knows this scoring system and the algorithms behind that, but we all have an idea.
Well, I could tell you, but I have to kill you, right?
Right. We all have an idea of what things can help credit, and really it's making the payments, and we can counsel them on, pay this collection off or pay this account down, and continue just to make the on-time payments, because oftentimes the only thing that heals your credit, even after you've paid it all off, they stay on there. Those late payments, it's time.
Right. It's time.
Yeah.
And so how can we make sure that they know that we're doing this? So if I've been busting my hump for a year and a half paying these things off, how do I know they'll know that I've done that?
Typically, the accounts that you're paying off that report monthly, the credit cards, things like that, they report monthly to the credit bureaus. So those things would automatically be reported.
Okay.
If you had, say, a past collection account at a collection agency and you paid that collection off, you always want to request the letter of payoff and that sort of thing, because they do claim that they send the information to the credit bureau, but oftentimes that person will come in and say, well, gosh, I paid that collection off a year ago, and that credit the collection agency didn't report that.
Right.
And so you always want to request the documentation and keep that, because then we can help you and give you the information of, hey, here's the credit agency, mail this to them or call them, and we can help them to then get it reported if it didn't get reported. So you always want to make sure you keep the documentation.
Now, believe it or not, we only have about 4.5 minutes left. It's a great conversation.
It's turned into a credit seminar, which is great.
Absolutely. And so let's say somebody's out there right now. I want to talk to Myles Link at Opportunity Bank, and I want to get a loan. So I come in, and what's the procedure? What do I do?
Yeah, I mean, oftentimes I'll talk to folks on the phone prior and get a little bit of history of where they're working, what they're doing.
Can we do most of this online? Or
we do have an online application as well. So
right.
Whether we do the application online or you come in, oftentimes we do have that conversation, and it kind of gives me the information I need so I can tell you, hey, this is what we're going to need, X, Y, and Z. Come in, we'll sit down. Most often first-time home buyers want to come in and sit down, and it's good too.
It's good because he's nice, and you need to do that because I think people do too much online. They depend on it too much, and that human factor is important.
Yeah, and we can write everything down and make a copy, and you can take it with you. It's something that you can revisit, and it creates more questions.
And then you can get that pre-approval letter, right?
Yep.
And so that letter, you pre-qualified and pre-approved, that gives you power in the marketplace, right?
Yeah, I mean, pretty much every agent now, when they put in an offer from the seller side or the buyer side, that everybody wants to see that pre-approval letter. So it is very important to come to the bank, lender, myself, get everything in line, get the pre-approval done. So when you go to put that offer in, you have the letter. So then the seller knows. It gives you more negotiation power when they know you've been to the bank and you're ready to go, fully approved, and you're not looking at property out of your price range because you didn't take that initial step.
Yeah, and the whole idea is to make sure that this purchase will fit into your lifestyle and into your budget, and it won't break you, because that's the last thing you want is to have somebody, default on a loan or whatever, right?
Yeah, and you want to still, like you said, fits into your lifestyle is the key. You don't, oftentimes banks can approve you for more than you feel comfortable with. So that's where we start is, where do you feel comfortable?
Mm-hmm.
And we try to put you in that right loan program, right payment, to where you have the place to stay and live,
right?
But it doesn't alter your lifestyle.
And just because you ask, well, tell me about your car payments and tell me about your credit card, you're not being nosy. This is something that's going to help you be able to afford this house.
Right. So we can get a full picture of what you have out there. And sometimes there are payments that don't show up on credit. Maybe you have a child going to daycare or private school,
right?
And those aren't going to show up on a credit report, but we want to know those things because that's a payment that you have that may impact what you should be looking at for a house payment.
Exactly. So I've asked you this before because you've been our guest many times, but I'm going to do it again. What is it when your feet hit the floor in the morning and you say, I put on my suit and my tie or whatever you wear at work? What do you can't wait to get to work to do? What makes it special for you?
I've been doing this 18 years now.
Wow. Wow.
And I really enjoy helping people find, the American dream, helping them. You're dealing with people typically in a fun, happy situation,
mm-hmm. Right.
Time of their life where they're going to buy maybe it's their first home, maybe it's their fifth home. Whether it's their first or fifth, everybody's excited to buy a home. And it's great to, like you say, hit the ground running in the morning and see who may call or what new leads may come about, and just continue to help people, and of course to clean up the emails that came from the prior night.
And of course, to quote a famous person, you never know what you're going to get, right?
Right.
So how do we contact you?
Yeah, cell phone is the best. I always give that out, and it's 406-544-5115. We do have the online application. It's just opportunitybank.com. And there's a tab in there, and you can choose me as the loan officer. My contact info, everything's in there as well.
Great. Myles, always a pleasure. Thank you.
Thanks so much.
You're a fountain of information, sir.
Perfect.
That's going to do it for Missoula Real Estate today. For Myles Link and for Diane Beck, we thank you for joining us here on KGVO. Thanks for tuning into Missoula Real Estate today. We hope you found the information over the last 30 minutes to be helpful. If you have any suggested topics for future Missoula Real Estate Today programs, or any questions about buying or selling real estate, please email Diane. Here's the address: It's Diane Beck at Realtor.com. That's Diane Beck at Realtor.com. We'll see you next week on News Talk KGBO.com, 98.3 FM and 1290 AM.